Hi everyone, and welcome back to a new video. If you are tired of overcomplicated strategies and overcomplicated trading models, then this video is one that you definitely do not want to miss. In this video, I'm going to share with you a strategy that you only need one candle for. You only need to identify one single candle, and everything else will be taken care of. So which candle should you be able to identify? Now, we are going to be using this model on the weekly time frame, and this model is extremely good for the people who are working a 9 to 5 and do not have time to day trade or scalp. Remember, price is fractal, so you can also apply this to lower time frames in the market. Now, what are we going to do? We are going to identify swing highs and swing lows in the market. And every single time price action creates a high, we are going to mark out those highs. We get a high, we mark out our high. If we get a new high here, we mark out the high, and we mark out the lows as well. That is the first thing that I want you to go ahead and do. Now, if for example, here we have that higher time frame, external liquidity. We are going to be using the weekly time frame to mark out the external highs and lows. So, the one candle that I want you to identify are the following. So, here we have that weekly external liquidity. Here we see one weekly candle that closes above this external high. And this is the candle that I want you to identify. I want you to spot out a candle that either closes above the high or rejects the high. Here we can see, here we have a continuation candle. This is a candle that closes above an external liquidity pool. And here we have a rejection candle, and this is a candle that fails to close above a higher time frame external liquidity pool. So what is the significance of these two candles? We are either going to have one of two scenarios. We are either going to have a candle, a continuation candle, or we are going to have a rejection candle. So when we have a continuation candle, this is what I'm expecting the market to do. If the market is strong enough to close above an external liquidity pool, I'm expecting a continuation in the run. If the market isn't strong enough to close above external liquidity, and then I'll be treating it as a liquidity raid, and I'll be looking for a reversal. This is a run of liquidity. This is a liquidity raid. There's a difference between the two. If we have a run of liquidity and we have a candle that closes into a liquidity pool, the chances are very high that this market is going to dig in deeper into this higher time from external liquidity. But as soon as we get a tap and raid liquidity and the body closes below the low, I'm expecting a reversal to occur in this market. This is a lack of displacement, and this is a very clear displacement above an old high or old low. So why is that significant? This is significant because if we get a closure above the high, I'm expecting a continuation. So on a lower time frame, I'm expecting this market to draw into some sort of PD array like a fair value gap or a breaker or an order block to take a continuation trade because we have underlying momentum. If we get a rejection candle like this, what this means is this is most probably a market structure shift on a lower time frame. Now, here we can see the wick did the damage, but the body is telling the story. If we drop to a lower time frame, we are going to get a market structure shift in this leg of price. So that is why I will frame a trade to the downside, looking for a retest of a fair value gap or a breaker block or an order block to take and target the next points of interest. Now, that leaves you with a clue. As soon as we get a closure above an old high, where would my next draw of liquidity be? It is going to be the next swing high or low. So if we have a swing high here and a swing high, and the market closes above this, the next draw of liquidity will be this swing high. If we've tapped into it and we have closed above, the next draw of liquidity will be this swing high. So I'm going to be looking for a buy position until we hit this draw of liquidity. In the same way, if we fail to displace above an old high, where's my next draw going to be? It is going to be the next swing low. So if we fail to displace, my eyes drop down and I look for the next swing low to potentially use as a draw on liquidity. So what can you see on this chart here? Here we are in Eurodollar on the weekly time frame, and we can see that we have this external high that is resting above, and we have this external low that is resting below. Now if we play price forward, we can see what happens. Price action trades above it, and do we get a closure above it? Not yet. And there we go. Here we get a closure above this swing point. Here we can see that we rejected this swing. And so we'll be looking for a sell down to this external liquidity pool. But if we drop lower, let's see if we get a market structure shift in this candle. From the weekly, we go to the 4-hour time frame. And here you can see, what do we have here? This is that higher time frame wick. Now, if you look here, you can see that we do not in fact get a market structure shift. If price action came and closed below this line, this swing point, that would be considered to be a valid market structure shift, but we don't get it. And so if you play price forward on the 4-hour time frame, we can see that we close above that swing high. Now, because we close above, what can we use as an entry reason? So first of all, we have to draw out our dealing range, and we can see that our dealing ranges, we have swept liquidity at the bottom. So this is our low point, and we have swept liquidity at the top. So that's where we anchor our dealing range. Now here we can see we have premium and we have discount. So we are only looking to buy in discount. So if I go ahead and I mark out my discount zone, let's make discount blue, remove the dealing range. Here we have discount. Now, where am I targeting? I know that I'm going to be entering off of a PD array in discount, but where's my draw on liquidity going to be? So for that, we have to go back to the weekly time frame, because that is where we identified our point of interest. Now you can see that we have closed above this point of interest, this higher time frame liquidity, buy side liquidity pool. Here we have another liquidity pool, but that has been mitigated and used there. So where would our next draw of liquidity be that's unmitigated? This one has been used, this one has been used, this one is still open. So this will be my draw on liquidity. Now that we have identified our target, let's see if we can spot an entry on the lower time frame. Dropping that back to the 4-hour time frame. Here we have that external. Here's the sell side. Now this magnet will be my higher time frame draw liquidity. And here we have identified our dealing range and the discount zone in our dealing range. So which PD array are we going to be using? We can use breaker blocks, order blocks, or fair value gaps. I love using fair value gaps for this strategy, so I'm going ahead and marking out the fair value gap that I can see in discount. Now I can remove my discount zone, and this will be my entry position, entry point for this trade. So if we get this market to drop down lower into this fair value gap and mitigate internal range liquidity, I'll be chasing in external liquidity. Remember, we go from external to internal, back up to external. We take external, we seek internal, and then we chase external again. And the cycle continues. Then we draw towards internal, and we seek external liquidity again. So here we've identified our internal liquidity. Here we've identified the external liquidity draw on the weekly time frame. So this is where I'll be taking my position. We can place stop loss either below the low of the fair value gap. We can place the stop below the swing point of the candle that created the fair value gap. And this is where I prefer placing my stop losses, because it is safer. And we want to give the market breathing room if it decides to draw down a little bit. Now we move our target, our take profit to our draw of liquidity. Let's just make this a clean 3-to-1. And we play price forward to see what happens. There we get a tap into our trade, and the market runs and seeks out external range liquidity on the weekly time frame. If you are tired of not seeing real results from the market and from trading, this mentorship program is one that you do not want to miss out on. This isn't just a course where I give you 20 videos online and I don't share anything, I don't guide you, I do nothing. This isn't that. This is a mentorship that goes beyond theory. We are running a promotion at the moment where you can save 20% on lifetime access. This is a welcome promotion just to celebrate the launch of the mentorship. But remember, this promotion ends at the end of November. In this mentorship program, you will learn exactly how I got funded $400,000 and was able to fund my personal account so I can go full-time without relying on prop firms. You can choose between a monthly or a lifetime membership, whichever one works best for you. You have access to a private Discord community where we keep each other accountable. If you are struggling to get funded, you can join my live trading sessions and I will guide you every single step of the way. I will trade with you until you get funded. Here we can see that you have weekly live trading. Every single week I trade live in front of the students. No hindsight is done. Nothing is done pre-recorded. Everything is live in front of countless students. Real-time market analysis. You get access to an in-depth trading course. Everything I have learned over a decade of trading. You have direct 24/7 support. I share my professional trading journal. You have personal coaching and you have full access to course updates. And if you don't want to believe me, just take a look at the amazing results that the students are busy getting out of this mentorship program. This is a no-nonsense approach to trading education. So if you are ready to take your trading to a professional level, this is something you do not want to miss out on. In this example, we can see that there we had our previous trade. And now what do we see? Here we have an external high that has been failed to close above. So I see this as a rejection candle. Now, because we have failed to close above, where would my draw of liquidity be? So if we don't close above, my eyes drop lower and I look for the next sell side liquidity. It is going to be this swing low. This is going to be my next draw on liquidity. So dropping down to the 4-hour time frame, let's see what we can see here. Now, let me just clean everything up. We can see here the market goes and raids external range liquidity. Now, what can we do? We can either wait for a market structure shift or we can wait for a change in the state of delivery. If we are going for a change in the state of delivery, I would want to see a body closure below this candle's opening price. This gives us our valid change in the state of delivery to target this swing low. Playing price forward, we can see we get that on the very next candle. So I can go ahead and place my sell limit order at the retest of this order block. Stops goes at the high. Let me just change this so I don't confuse anybody. Stops goes at the high, and we can go ahead and take partials along the way and ultimately leave a small runner running until we hit our next draw on liquidity. So if I play this forward, let's see what happens. Here we get a tap into our position, and now we can simply wait for the market to run into this swing low and this swing low to take partials. Price action retests the order block, and let's see what happens. Here we drop lower to this low, so here we can take and secure partials, leave it running, and eventually price action runs down and hits my weekly sell side liquidity for 6.2 R total on this trade. So keeping it simple, we're just going to continue along with this currency pair and to see how price plays out. So now that we've won our trade, what do? We reset our analysis. So we go back to the weekly time frame to look at what's happening on the chart. Okay, so here you can see there we had a rejection candle. Here we have a continuation candle because we have a closure through this sell side liquidity. So because this candle closed through the sell side, where would my eyes follow our draw to next? Because we closed below sell side, my eyes drop lower to look for the next sell side swing point. The next sell side liquidity on the weekly time frame is going to be this unmitigated liquidity pool here. So this becomes my new draw on liquidity. So now I can go ahead and frame a sell trade until we hit this sell side liquidity pool. So from the weekly, we drop back to the 4-hour time frame. Here we can see this market closed under the sell side liquidity. So what do we do now? Now we identify a PD array the price action can draw into to give us a rejection to take a short down into our liquidity pool. So what do we have? Here we have a very big fair value gap that has been unmitigated. So we can expect price to draw into this fair value gap and give us some sort of entry reason to take a sell until we hit our long-term draw on liquidity. Playing price forward, let's see what happens. Here we can see price action draws into our fair value gap, and so we are waiting for a change in the state of delivery. We have 3 consecutive up-close candles. If price action closes below the opening price, that would validate this as a bearish order block. Do we get a close? The market doesn't close, so it's not valid. Price action sweeps the high again, so our point moves there. We have 3 consecutive up-close candles waiting for a closure below the low. Do we get a close? Not yet. Do we get a close? Not yet. How about now? Not yet. Do you see why you should be waiting for body closes and not wicks? It is very important to wait for a body closure below to confirm your bias. And what do we get here? Here we get 3 consecutive up-close candles that get closed below with a body. This makes this a valid bearish order block. So I can simply go ahead and take a sell on the retest of the order block, place my stop above the high, and we can go ahead and target. Our long-term target will be this weekly draw on liquidity. Playing price forward, you can see we get a tap into this order block on the very next candle, and let's see what happens. And there you go. Price action runs down, hits my weekly draw on liquidity for another 6.9 hour trade. So in a matter of 70 days, 3 months, we have 3R, 6R, 7R, 16% in 3 months with a swing trading strategy where the analysis took you less than 5 minutes. That is extremely good. And remember guys, this is only one pair. If you trade this on multiple pairs, you'll be set for life. You will be able to trade this while you have a full-time job without interfering with your office work, and you'll do this on the side until your trading account grows to a position where 6% a month is more than enough to sustain you and your family. I hope you guys enjoyed today's video. I try to keep trading as simple as possible, so if you agree, if you like the video, please leave a comment down below. Please leave the video a like. If you want to join the trading mentorship and elevate your trading to the next level and dive deeper into how the markets book and how the markets actually move, I recommend and suggest you check out the mentorship program. It will change your trading. I guarantee it. Guys, I'll see you in the next video.